Here we're going to be going through a summary review of inventory accounting methods, and we're going to look at the FIFO, LIFO, average cost, and specific identification. Now, using these methods determines on how the inventory is valued here on the balance sheet and on the income statement. So we purchase inventory here as an asset, and then when we use it, it gets expensed on our income statement. Now, so our asset inventory evaluation and our expense recognized here depends on whether we're using older or newer inventory, which have different costs. Now, the examples I'll go through here I'll have listed in table form, where I've got the oldest inventory listed on the top, and then as we move down the table, that would be our newest inventory. Okay, let's look at our inventory here as first in, first out, or FIFO. This is where we use our oldest inventory first. So any items purchased or manufactured first will be sold first. So our cost of goods sold for the inventory here would be using our oldest prices, and that's what's reflected on our income statement, those oldest prices for our inventory. Now, what remains in our inventory would be our ending inventory. Now, that would reflect here our newest inventory or our most recent prices. Now, that is what we include here in inventory account on our balance sheet. Now, our balance sheet would have the current cost or the newest inventory, whereas our income statement, or what we recognize here as a cost of goods sold, would have our older prices, because that's the inventory we use first, this oldest inventory. Okay, let's look at inventory as last in, first out, or LIFO. This is where we use our newest inventory first. So the items that we most recently purchased or manufactured would be sold first. And that's what we recognize here as our cost of goods sold for our inventory, our income statement. So the income statement has the current sales matched with current costs. And what remains here in our ending inventory would be our oldest inventory, and those would be our oldest prices for our inventory. And that's what would be included here in our inventory account on our balance sheet. Now, that balance sheet here would have these older costs for our ending inventory, whereas our income statement, that used our most recent costs or our current costs for our inventory. All right, let's look at our average cost or weighted cost method. This is where we take the total cost of the beginning inventory plus the cost of all the units purchased during the period and divide by the total number of the units of inventory for the period. So what we're doing here is we're taking our oldest and newest inventory costs and just averaging them together. So we're using the same unit price here for the items on our cost of goods sold on our income statement as we are for our inventory on our balance sheet. And in this case, we can use either the periodic or the perpetual moving average methods. Now, the periodic method takes our average cost for the period, while the perpetual updates the cost each time a purchase or a manufacture is made based on any remaining inventory and the amount purchased or manufactured. All right, let's look at a specific identification method. This is where we take our inventory on our balance sheet here and we make specific selections from it. Now, it could be either an older or newer cost, but whatever selection we make, that's what we expense here as a cost of goods sold on our income statement. So our costs are matched for each of the item when they're transferred from our inventory on our balance sheet to our cost of goods sold on our income statement. So the specific identification identifies the cost for each inventoried item. And then whatever remains here in our ending inventory, that could either be an older or newer cost, or it's whatever is left over after we use our inventory. Okay, let's summarize these inventory accounting methods. We'll start with our FIFO. That would be our first in, first out. So this is where we used our oldest inventory first. So our cost of goods sold on the income statement would include those oldest inventory costs. And then our ending inventory, that would be our newest inventory costs. And those would be the costs that we would include here in inventory account on the balance sheet. So those would be our current inventory type costs. And then for our LIFO, this is where we used our newest inventory first. So our cost of goods sold on the income statement would include those new newest inventory costs, and those would be a more current cost. Now what was remaining here would in our ending inventory would be our oldest inventory, and that would be included here in our inventory account on the balance sheet, and those would be the older inventory costs. Now when we're using our average costing method, this is where we're taking our oldest inventory and our newest inventory and just averaging those costs together. So we get one unit cost here. And that same unit cost would be used here on our balance sheet and our inventory account, as well as our cost of goods sold here in our income statement. Now using our specific identification method, this is where we've just taken specific items here in our inventory account and just moved them over here to our cost of goods sold account. So we're matching our costs here between our inventory account and our cost of goods sold here in our income statement account. Now you can see that using these methods here, this is how we determine our inventory value here on our balance sheet versus how we expense it here on our income statement.